Welcome to the second paper session of the first Tracy Mott workshop. Unfortunately, the presenter audio, due to technical issues, will not start until 1 minute into this presentation. I appreciate your patience and enjoy the rest of the presentations.
So macro effect of when sectors distribute change cannot be generalized based on Fujita and Dutt's work. So it depends, it means it depends on assumptions and specific condition for each country's situation. And South Korea, especially launched the heavy and chemical industry promotion during the 1970s, which is the largest scale industrial policy in the history of Korean development. So the effect of selective industrial policy on economic growth and income distribution is rarely been studied. So my research question is, how does the state selective industrial policy affect the sectoral capacity utilization, and what is its distributional implication?
Yes, actually you advanced.
Oh. So this is my research question.
Can you go back?
So this is a kind of overview of Korean development history. So we did a colonization period, and then after that, land reform. Land reform is pretty much like Korean version of Jubilee. So we dismantled all the private ownership of land, so that we can kind of dismantle the feudalistic economic systems. And then we launched the labor-specific, labor-intensive industrial policy as an initial stage of our development. But actually, the strategy actually doesn't last long because of the rise of China and Vietnam. So kind of wage payment, the lower wages does not really work anymore for Korea. So after that, policymakers had to think about, so what could be some other strategy to deal with this situation. So one of them is actually heavy and chemical industry promotion. But also from the geopolitical side, at the time, according to the Nixon doctrine, so US just announced that they will not provide a military support for Korea. So it was quite a shocking and surprise to every policymaker. So definitely we should develop the heavy and chemical industry. But it was not really easy to start because of kind of Washington consensus advisors kind of advised that, hey, you guys like Econ 101 and you know the comparative advantages. So South Korea at the time was really good at, mainly the agricultural based economy. So you guys are really good at the agriculture and look at the, like a beautiful, rice paddies. And so you should specialize in the agriculture instead of heavy and chemical industry. So our kind of government response was like, no. And so we just go ahead to develop the heavy and chemical industry promotion. So that's kind of brief contextualization of the brief history behind the HCCI promotion. So this is the one of the main the policy measure, which is the preferential interest rate, which is as you can see, the real interest rate almost below the zero. The red color is for preferential interest rate. So But if you are selected, then you can actually access to those preferential rate. But otherwise, you have to depend on the outside market, in other words, curve market. So, which is really difficult to get easy access to the cheap credit. So this is the what happened during the policy. That is the policy loans are really terminated during the promotion period. So as you can see, the clear difference between before and after. And this is so this is one observation during the HUCI promotion. So you can see the labor income share was obviously declined. So the orange line is the raw data, but when you consider self-employment, and then we measure the labor income share, and the trend was, overall trend is actually declining during the HUCI promotion period. And this is a real sector. This is a sectoral capacity utilization. So it's a rising until the end of the final stage of HUCI. And then eventually it actually declined, which indicating some recession in the final period of HUCI promotion. And another prominent observation we could see from the HUCI promotion is the rise of chaebol. Chaebol is a very Korean-specific, large, mega-sized big corporation, which is run and owned by family members. So those big corporations actually emerged and grew significantly during the HUCI promotion. As you can see, the GDP percentage is almost at 30%, just for top 10 chaebol firms. So like the top 3 includes like a Samsung, Hyundai, and LG. So those 3 companies actually takes an enormous proportion of entire GDP. And of course, because of there's no like a limit to the credit, so the debt equity ratio is skyrocketing during the period. This is the kind of intention behind the industrial policy. So definitely structural change happened during the period. And as you can see, the population of labor workers are also increasing during the period. So all these 4 things are kind of major observation during the HUCI promotion period. So now after HUCI promotion, we kind of scholars try to evaluate HUCI promotion. So this is some kind of consensus among the scholars. So first one is a selective industrial policy generates winners and losers. So basically selective industrial policies are just picking the winners. So as a result, losers are supposed to be, suffer because of many limitations, limited resources. So 3 things are mostly common tendency among them. First one is market increase as a rent-seeking behavior. And also they carry the excess capacity as entry barrier because they try to stop all the competitors and rivalries and through the excess capacity. And third one is overinvestment, definitely. So during those periods, we got some kind of myth, too big to fail myth among all the big companies. So which is kind of bad for Korean economy in the long run. So many people blame those myth as a kind of cause of financial crisis in 1997. So these 2 things are pretty much significant negative side of evaluation. So first thing was significant deterioration of income inequality and declining in the wage share. So the income distribution was really get worse during the period. And then capital misallocation and massive idle capacity. As you could see the previous slide, the sectoral capacity utilization actually declined during the period. So this is 2 major things among the scholars. So this is my methodology. So I want to see that what's going on in the industrial policy period. So I took Kalatsky and Steiner framework based on their seminar work in relatively old time. So implication of this Kalatsky-Steiner framework is mainly two things. The first one is income distribution is pretty much determined by the market rate. So this simple algebra showed those relationships between income distribution and market rate. And second one is, this is specifically from the Steindl. So upward trend in markups leads to recession and stagnation. So Steindl actually argued that there's some kind of tendency behind the markups. It is a kind of upward trending. Always markup is upward trending. So he's actually finding is very much consistent with today's findings. Many even neoclassical scholars admit that since 1970s, 80s, actually the market power, the markups are keep increasing until now. And then another specific thing about those trends is this is not the overall trend for overall companies, but rather it's because of market power of small number of like superstar firms. So I thought that, so this is very much a Korean style because we have several superstar firms like Jebels. So Jebels are pretty much superstar firms. So I just choose this this framework as my main workhorse model. So this is kind of description of my model. So I try to extend the existing canonical Kalatsky-Steiner framework to incorporate these selective industrial policy components. And also I extended this from closed economy to incorporate some open economy features in my model. So first thing, the component is preferential interest, loan interest rate, as you saw already in previous slide. And then second one is a higher saving rates mobilized by the government. And third one is unilateral dependency between the selected industry and non-selected industry. In other words, heavy industry and light industry. So due to the protectionist trade policy. So the light industry have no option but to depend on output from the heavy industry. So those dependency is last component of industrial policy. So here are 4 assumptions. So only funds in HE industry sector export, because this assumption is based on the fact that light industry firms actually can mostly feed the domestic demand, but for heavy industry, actually they need more demand. The domestic demand is not really sufficient to feed their products. So they have to export, otherwise they will just collapse. So only capitalists save for simplicity. And I took a layout of production technology, which you will see later. And labor is always abundant. This is also, this assumption is just to further simplify my models, which you will see shortly. So this is a model description. So the first equation 1 is a Leontief production function. I think most of you are familiar with this technology. So Leontief is just all the technology pretty much fixed. You can substitute with each other between the capital and labor. And second one is I can kind of reduce Leontief production function to a product function with a single variable, because it's possible, because my assumption is labor is abundant. So that's why I can reduce. And the N is a required labor. So this is from the Leontief production function I just derived. And this is market pricing. This is market pricing equation. So each industry, each firms from each industry has a specific markup pricing equations. So I know that I have only 5 minutes and still have. So, okay, so let me try. So this is an investment function for each industry. Oh, sorry. So this investment function is just before evolving to the boundary margarine style investment function. Just I keep the previous style because I want to use the interest rate, one of the key variable of my framework. And international trade. So only each industry firm can export. So this is the export depends on the terms of trade. So all with this, I just what I'm trying to do is I derive the excess demand function and then I get the equilibrium. So then finally I got this equations for sectoral capacity utilization function. So this is kind of my conclusion of equations. So I try to plot those two sectoral capacity utilization equation on the plane here. And then you see that if I change the market rate of heavy industry, then equilibrium will move into the from E0 to E2. So you see that heavy industry, the capacity utilization is a level almost the same as before. But obviously, the light industry utilization is much lower than before. So it's really affected by the market power of the heavy industry firms. And then this is the interest rate differential effect. Sorry. So if we lower the interest rate for the heavy industry, actually our equilibrium is way better than before. So it's a bit opposite to the neoclassical idea that if you higher the interest rate and then economic growth is actually lower. But this research shows the opposite to mainstream arguments. And then this is the saving rate. Also saving rate, a higher saving rate positively affect sectoral utilization. And then lastly, it's an oil price shock. So oil price shock actually, So oil price shock is pretty much really devastating to the economy. So you see that the both sector actually utilization is pretty much lower than before. So my conclusion is this. So in conclusion, selective industrial policies in terms of economic growth, So in terms of economic growth, industrial policies are kind of double-edged. It could be positive or it could lead to negative growth, but it really depends on other effects dominate, whether other effects dominate the monopoly power or market power or market rate effect. So as long as the positive effect dominant to the negative effect of monopolization, then industrial policy could be the positive effect. And last effect is this regime is pretty much vulnerable to external price shock. As you can see, the oil price shock is really disastrous to the economy.
And next we have Dr. Yoon from.
Okay, thank you. Okay, so my paper is about a study on non-financial corporation, US non-financial corporations, liquid asset holdings, and its increasing patterns over the last 30 years. And I was inspired by my reading and understanding of Post-Keynesian endogenous money and liquidity preference theory to understand and better understand these empirical patterns. Okay. Yeah, this is the empirical pattern. I can show you. So this is the US non-financial corporations liquid financial asset holding ratio. So on the nominator, I calculated that liquidity asset holding by non-financial corporation as a sum of transaction deposits and non-transaction deposits and non-deposit financial assets. Then in the denominator, I calculated net assets, which is total assets minus net debts. Okay, by doing so, I can highlight the patterns in this slide. So in 1950, that ratio was about 7%. And then through 1980, it has shown mild declining trend. Since 1980, that pattern dramatically risen. Since 2000, we can see plateau for the next 20 years. So on this pattern, there had been increasing research on that pattern. In mainstream finance journal, they provide a term called corporate cash holdings. Okay, this is about physical cash holdings. Okay, the approach is based on holding physical cash and talks about what would be underlying behavioral motive for making them hold more and more over time. So first, they provide tax motive. So we know that under the globalization, multinational corporations increase their power, but there was a tax, high tax for profit repatriation back to the United States. Because of that high tax rates, they have to hold just cash because they cannot take back to the United States. Okay. Second one is agency motive of entrenched corporate managers. So managers wanna increase their power instead of distributing and pay out to their shareholders. So second assumption. And third one is we know that over the last 20 years, there was increasing industry and firms that is based on intangible asset intensive firms. Okay, so the thing is they are constrained, financial constrained to borrow from financial markets because their assets are intangible. So they cannot use, they have a difficulty in using that intangible asset as a collateral to borrow money from external financial markets. Okay, so now let's talk about post-Keynesian and post-Khawaja approach to the same empirical patterns. So that literature emphasized the owner-manager conflict starting from Jim Crotty's paper in 1990 and asset portfolio choice given a growth profit trade-off inspired by Steindel's initial paper. After then, shareholder value orientation of managers inspired by or caused by kind of compensation scheme change to their managers. So their class interest is now shifted to the interest of shareholders. So as a result, there was a rising preference for short-term profits that leads to a shift in corporate asset portfolio toward liquid financial investment. Okay, and then over the last 10 or 15 years, there have been increasing body of empirical literature. So they emphasize the relevance of financial incomes and the differential between financial income and operating surplus and cash flow volatility and intangible asset industries and other firm characteristics that make that kind of change in corporations portfolio change. Okay. So my question is, by looking at and reading existing literature, I was curious why there's no paper about that address the importance of balance sheet structure of financial institutions and also the endogenous liquid asset creation process. So that's why, between 1980 through 1990, there was, a lot of literature on, the debates about liquidity preference and endogenous money supply. So I was inspired by the key ideas in that debates and then apply that idea into understand these empirical patterns. Okay? So intuitively, non-financial firms' demand for liquid asset may not be independent of liquid asset creation process and financial institutions' active balance sheet management and their structural change in the industry. So my main arguments is that considering the decline in traditional type of banks, the development of the financial institutions' liquidity preferences should matter for non-financial corporations' asset portfolio. Okay, so there are, I already addressed that types of ideas. Key questions: what would be the channels between non-financial corporations' asset portfolio and balance sheet structure of financial institutions? Okay. So I developed literature on financialization. And then I wanna provide alternative approach to these patterns. So, okay, there are two, my hypothesis is based on the existence of two primary liquid asset creation channels. The first one I call bank advance channel, which means banks' industrial loans going to firms create the supply and demand for transactions deposits. And second channel I call liquidity preference channel. So financial institutions already involved in active balance sheet management, and also there had been substitution of interest-bearing managed liabilities for traditional transactions deposits, and that induced non-financial corporations to hold more and more of interest-bearing managed liabilities. So that's my main channel to understand liquid asset holding by non-financial corporations. Okay, so now how would be empirical patterns? So as I said, as a first, based on the idea in the first channel in endogenous money, banks, industrial and commercial loan automatically create transaction demand, supply of transaction demand and demand of transaction demand. So in this graph, one side is non-financial corporations, liquid asset holding, and the other side is about banks, industrial and commercial loans. So between 1950 through 1980, it's not that very close, but we can see, you can find kind of corresponding relationship between these two lines. But since 1980, there's huge and widening gap between non-financial corporations asset holding, liquid asset holding, and banks, industrial and commercial loans. So how we can explain, how we can fill this gap, widening gap, by thinking about some other channels, other money creation channels and money holding channels. Okay, so for this, I want to show you first the evolution of credit side market in the US financial sector. So the dotted line indicates mortgage loans as a share of total loans. And then the just line that showing decline trend is industrial and commercial loans as a share of total loans. So since 1980, there is a diverging trend between that mortgage loan and industrial and commercial loans. Second, this is about liability structure of non-US financial institutions. So the blue areas in the bottom side indicates financial institutions transaction deposit supply. And the intermediate, the middle areas shows financial institutions non-transaction deposit that include saving and time deposits. So, and then the upper area is about financial institutions non-depository liabilities that include money market fund and mutual fund and short-term commercial paper issued by financial institutions. Okay, so between 1960 through 1980, the non-transaction deposit was one of the main parts and increased importance in this, among these liabilities. But since 1980 or from the late 1970s, we can see increasing dominance of non-deposit financial liabilities. So that portion definitely related to non-financial corporations' liquid asset holdings. This is the graph I can show you. So in 1950, non-financial corporations exclusively hold transaction demand deposits as a liquid assets. Since then, non-transaction deposit increases power in that graph. But since 1970s, you can see non-financial corporations increase non-depository financial assets. And since 1980, we can see dramatic increase in holding of those interest-bearing managed liabilities issued by non-depository financial institutions. Okay, so once we just look at aggregate trend, we can simply say that, okay, from 1950 through 1980, there's a declining trend, but we can just compare speed of change. Transaction demand rapidly declined, but interest-bearing managed liabilities slowly increased. So by comparing this magnitude, in aggregate, there was a declining trend, but since 1980, the magnitude, of increasing non-depository financial asset dominates transaction deposit. So that's the that generate aggregate pattern of non-financial corporations' liquid asset holdings. Okay, what would be the significance of these patterns? So I want to say that kind of connections and correlations between asset side composition of financial institutions and liability side of balance sheet of financial institutions and the shift in non-financial corporations liquid asset holding as a main interest of my paper. So now let's think about theoretical discussion. So Tracy Mott provide complicated and comprehensive understanding of liquidity platforms. So the background of this paper was written after Asma Cook's paper in 1983, and his critique of Khawaja Keynes for exaggerating the independence of investment from saving. So he said there should be saving constraint. In the period between initial finance and the period when the multiplier effect is fully realized. So resource is constrained in that period. So who can finance that deficiency in finance? So financial sector or supplier of finance can provide some fund for that gap, fill the gap, but their liquidity condition will be hurt by providing funds in that period. So it generates upward pressure on long-term rates. So and also term structure also get widened, and investment will be like crowded out by rising trend of liquid, long-term rates. Okay, so key emphasize that. So I just want to show that the key idea can be summarized. Investment is self-financing, not only exposed by creating the saving it needs, but also exempt by creating the financing needs. So how, second side. Okay. So the key is impact of expected profitability on liquidity preference of the bank and business. So he rely on Robinson's writing and Kallecki's writing, and also Keynes's writing or treatise on money. So, okay, and then the question is like this. After then, I just wanna say that, okay, so I wanna support the interpretation of liquidity preference theory as a theory of balance sheet choice. So based on this, I wanna proceed to the following way of showing models. Okay, and then I try to derive financial institution liquid preference schedule and also non-financial corporations liquidity preference schedule. So endogenous variable is the size of liquid financial asset in this model. So liquid preference schedule will generate equilibrium points where the supply and demand of liquid financial asset is determined. Okay, so after that, I will show you what would be impact of financial innovation in this liquid financial asset based on the idea of Minsky's paper in 1957. So finally, the point will move to A to point B. So which means that when financial institutions make leveraged balance sheet expansion, then the supply in a kind of liquid supply curve, preference curve of financial institution will move rightward, and then interest spread will go down because interest-bearing managed liabilities increase at that squeeze liquidity, squeeze interest spread, then there should be larger size of liquidity ratio in these dynamics. Okay, let me move to how we can measure liquidity premium. So estimation procedure is following like this. So liquidity premium in this money market is calculated by using 3 months treasury bill rates minus weighted interest rate of financial institutions' liabilities. Okay. By doing so, I have regressed interest spread on asset growth rate of various financial institutions and real GDP. So this provide, and also I used 2 different interest spread measures. One based on first one, and second one is based on more disaggregated version of interest spread. After then, this table shows the impact of growth of different financial institutions on interest spread. So means that market-based financial institutions asset growth negatively affect interest spread, but depository institutions asset growth positively affect interest spread. Okay, so and then my main point is about the evidence of long-term relationship, equilibrium relationship between non-financial corporations, liquid asset holding, and 2 liquid asset supply channels. Okay, so to think about this, I just want to show long-term patterns by manipulating the graph, my main variables. So one variable is a fraction of non-financial corporations liquid asset holding that is not related to banks, industrial and commercial ones. Okay, and the other one is interest spread. By looking at this, we can find somehow very close movements So that indicates or signifies long-term relationship, equilibrium relationship between these two main money supply channels and liquid asset holding by non-financial operations. Move on to unit root test to proceed to co-integration test. After that, I was able to find just one equilibrium relationship using Johansson rank test. And I also used two specifications. One is 3-variable test and the other one is 4-variable test. The other variable is non-bank to depository bank ratio. Okay, so this is the result. Okay, so I have used two liquidity premiums. One is PB premiums and the other one is more disaggregated version of interest rate. And then Johansson test and the other one is dynamic OLS. And the first two column shows like 3-variable test result, and the next two columns provide 4-variable co-integration test. So bank, industrial, and commercial loans increasing made positive impact on non-financial corporations, liquid asset holdings, but liquidity premium shows negative relationship with these non-financial corporations. And then we can also find somehow interesting impact when we include non-bank to bank asset ratios. Once we include this variable in that co-integration test, the impact of liquidity premium declined. That means that non-bank to bank ratio affect liquidity premium. That's why we can find reduced impact of liquidity premium on non-financial corporations' liquid asset holdings. Okay, and then this is impulse response test based on error correction model, and I was able to find bi-directional causal relationship between liquidity premium and non-financial corporations' liquid asset holdings. So I must say I kind of proved my hypothesis. But one of the interesting things is that the non-financial corporation liquid asset holding also cause a change in liquidity premium that may be, because of supply of interest-bearing managed liabilities that leads to more liquidity premiums. Okay.
And we really have to.
Okay. Yes. Yeah.
So.
Okay. Theoretical model and time series model provide these data and my implications. So, what would be benefits of financial innovation?
Maybe we'll let the audience read as I switch over, just so that we can protect the time of the last presenter.
Okay. Sorry. Yeah. So, yeah, you can see this. So, just only the second one. The transformation of financial industry has been taking place. So, yeah, I just want to show that liquidity preference channel increased importance in understanding this. Okay.
Well, thank you. Firstly, I want to thank the organizers for this wonderful workshop in honor of the late Professor Tracy Mott. So thank you for organizing this. I'm going to present this paper on analysis of UK swap yields. This is joint work with Professor Mamun of Cyber University in Connecticut. I work at a bank, and my co-author works at a university. So I will start with a disclaimer. Whatever I say is my views and not that of not that of anybody else. Let's start with the highlights of what I'm going to say. Keynes claimed that the central bank's policy rate, as well as other monetary policy actions, influence long-term bond yields via the short-term interest rates. This conjecture is supported in the empirical literature, in the Post-Keynesian literature, paper by myself, and as well as other Delidi and Levrero in recent issue in Metro Economica, Gabriel in recent issue of a review of Keynesian economics, and specifically looking at the connection between short-term interest rates and yields holds in the UK as well in a recent paper, not only by myself, but other authors authors. So the question that I'm asking in this paper is that does Keynes's claim about the connection between long-term interest rates, swap yields also hold in the UK, for the UK? That is, does the short-term interest rates have a decisive influence on long-term interest rate swap yields? That's the question that I'm going to address. That is, going beyond treasury notes or government bonds. Does it apply to spread products or swap yields, long-term swap yields? So what I do in the paper is to model the dynamics of interest rate swap yields econometrically to examine whether Keynes' conjecture holds. And to the bottom line is that yes, we find that's the case. That is, for the change in short-term interest rate has a decisive effect on the change of long-term swap yields after controlling for a number of macroeconomic and financial factors such as the change in core inflation, change in the growth of industrial production, percentage change in equity index, percentage change in the exchange rate. This paper is a part of a project to empirically model interest rate swap yields from a Keynesian viewpoint, not only for the UK, but for other economies as well. So those are the main points of the paper, and I will elaborate on the rest again. So let's start with what Keynes had to say about long-term government bond deals, and just as a way of background, and then we're going to extend. So Keynes's view was that monetary policy drives long-term interest rate to the short-term interest rate. He said in the treatise of money, on money, the influence of short-term rate of interest on the long-term rate is much greater than anyone would have expected. Also quoting again, short-term interest rates influence long-term rates more than the reader might expect. It is not difficult to find sufficient explanation for this observed fact. And he goes on to give a number of explanations, and he concludes that there's no reason to doubt the ability of central bank to make its short-term rate of interest effective in the market. He had emphasized earlier in the importance of the policy rates in the first volume of the treatise on money, the efficacy of the bank rate for the management of managed money. There was a great discovery. Its application in varying conditions were not clearly understood and have not been clearly understood to this day. He drew on empirical work by statisticians in the Federal Reserve in the 1930s, Reifler in particular, who went on to have an interesting career as secretary of FOMC, but also on his own experience as a speculator in the UK market. So, and Reifler's conclusion was that the surprising fact is not that long-term bond yields are relatively stable in comparison to short-term rates, but they reflect fluctuations in short-term rates so strikingly and to such a considerable extent. Keynes was also aware of the limits of the power of the central banks, and he pointed out the short-term interest rate is easily controlled by monetary authority, but the long-term interest might be more recalcitrant. So yes, the monetary policy is important, but it's not the only thing. Other factors matter as well. He acknowledged, in particular, he said that if monetary authorities are prepared to deal in both ways on specified terms of debt of all maturities and debts of various degrees of risk, and the relationship between the complex rate of interest and the quantities of monies would be direct. And in particular, if the central bank, offer by central bank to buy and sell at stated prices of gilt-edged bonds of all maturities in place of a single bank of short-term bills, is the most important practical management that can be made in the technique of monetary management. So all of QE is there in, Bernanke did not invent it. So it was very much there in the treaties as well. So okay, so I'm going to talk about, given this background, I'm going to talk about interest rate swaps. Why? Because interest rate swaps are very important. The total amount of outstanding interest rate swaps is large, about 400 trillion in notional terms and 8 trillion in gross market value. So it's a big amount. In pound sterling, it's also quite substantial. As of last year, according to BIS, 47 trillions in US dollars notional terms and about 1.2 trillion in gross market value. Clearly, this is an important part of the OTC derivatives market in global financial markets and financial system. And we just look at it visually. I mean, this is a large amount, and it's been rising. And in terms of gross market value, there's obviously some adjustment, but still a very large amount in total interest rate swaps globally. And in pound, in British pound, also quite substantial amount of outstanding and value. Okay, so let's look at the evolution of of interest rate swaps. This goes the evolution. I mean, like all interest rates have been declining until recently. So this shows the evolution of interest rate swaps. Also, and if you just look, visually, the relationship between short-term interest rates and 10-year swap yields seems to be pretty tight. Just looking at visually study. Okay, so I'm going to look at a bunch of data. I'll tell you what they are. Swaps of different maturity, 2-year, 5-year, 10-year. That's the thing that I'm going to try to explain. I'm going to use short-term rates. I choose LIBOR 3, but I could have chosen other short-term interest rates as well. I chose LIBOR 3 because I have the longest series on a monthly basis available. And some macroeconomic variables that we use are core CPI, headline CPI, year-over-year change, and for activity, industrial production, year-over-year change, financial variables, exchange rate. We use monthly data from 1990 to March of 2022, so about 387 observations, and the data come from standard sources, Refinitiv, ONS, Bank of England, FT, and so on. So, and we start with very simple models. The simple model is just change of swap rates as a function of the change of short-term interest rates. We have some bit more basic models, a swap of different maturities, change of short-term interest rates. We use total CPI, but core CPI could also do industrial production. Yeah, and the extended models we have everything: short-term interest rates, change of CPI, industrial production, the percentage change in the stock equity index, and percentage change in exchange rate. I'll skip over the summary statistics. We start with some unit root tests. So the levels, these are non-stationary in essence, or mixed. So we're going to look at at the first difference. We have pretty nice result, and that's why we're going to use it. These are essentially stationary, using different bunch of tests. And we run just OLS models, and we see and do an arch autoregressive conditional heteroscedasticity test, and there is presence of autoregressive conditional heteroscedasticity. So with that, we decide that what we want to use is a GARCH-M model. Why GARCH-M? These are useful in the analysis of time series data, particularly in financial applications where there's interest in studying volatility. And if you think investors require a premium in holding a risky asset, and the risk is captured by volatility, then conditional volatility may enter conditional mean fluctuation, or maybe function of YT. I'm not going to say that this is GARCH is probably the way of modeling increased risk, but maybe there is some connection to this, and we use simple GARCH models. So this is so what is just we add a variance equation to that. Okay, so these are the results. So I'll just quickly summarize. So yes, we find that the change of short-term interest is positive and statistically significant. all the time, starting from from 2-year, irrespective of the models that we used, whether the controls are simple, basic, or extended. So that's for 2-year, 5-year, and 10-year. It's always there. Moreover, if you look at the variance equation, we see that the arch terms are positive. The variance equations or the variance terms are also positive and statistical significant. What does this mean? That the arch term being positive and statistically significant, that the volatility shocks, feed from 1 month to the next. That's the evidence of that. And the positive and statistically significant arch term implies that that a large shock will have a kind of lead to persistence variance over a long period of time, and we do a bunch of diagnostic tests to see if this is this holds. So that's really the story. Let me kind of summarize the conclusion. Our conclusion is that an increase in short-term interest rate is associated with the increase in the long-term interest rate swap yield after controlling for a variety of macroeconomic factors, like change of inflation or change of core inflation. I showed the results with inflation, headline inflation, but we could have used core inflation, change in industrial production, equity index, change in exchange rate. We find evidence that there's the variance equation. These terms are positive, and I've provided the interpretation. What does this mean? This means that the Bank of England's decision on policy rates exerts a marked effect on the interest rate swap yields via monthly change in short-term interest rates. The effect is most pronounced not only in the front end of the swap yield curve, but also the back end of the swap yield curve. What we conclude is that from this empirical finding, that Keynes's conjecture regarding the importance of central banks' influence on long-term interest rate swaps also hold interest rate not only hold for treasury or gilt-edged treasury bonds, but also for long-term swapping. So Keynes' conjecture can be extended to interest rate swap yields. These findings are aligned with empirical patterns that we observe not only in the UK, but also in other markets. As I said, this is part of a larger project. We're doing work on the US, Japan, and others, and we appear to find a similar conclusion. So that's the essence of our research. Thank you very much. Thank you for the opportunity.